All opinions and views expressed by the speakers are not representative of views and opinions of RBC Dominion Securities, Inc. All information and opinions provided in this video are in good faith, but without legal responsibility.
Hi, we'd like to welcome everyone once again to our Thompson Wealth Management Solutions Fast Fives. I have Rob Smith, Senior Associate Manager, as well as Dominick Hardy, who's Vice President and Senior Portfolio Manager with our Portfolio Advisory Group. For longtime clients and people that get our emails, you'll see every week we send out our weekly insight. That is another part of our Portfolio Advisory Group and just talks to the depth that we have on our team when we're managing and planning investments for our clients. Dom, you've been with the firm for about 20 years now. Tell us how, you work between the team of analysts that RBC Capital Markets employs and the advisory team that's spread out across the country.
Oh, great. And thanks for having me, Greg, on your talk or your podcast. It is a great relationship. We work closely with RBC Capital Markets. I'll give you an example. We come in at 7 a.m. and right away we go on a U.S. call. We get to catch up with the research analysts and what's moving the markets in the futures and what happened overseas. Then at about 7:15, we go right Canadian call where we get an update from the research analysts, research reports that they've published on, discussions they've had with management teams, because they often do investor updates, investor meetings with shareholders. And the best part is we get access to those analysts. So when I see something that's very interesting or a great note, and I want the investment advisors to hear it right from the research analysts, they make themselves available for the 8:45 call. And that call is nationwide. And it's great because I have interactions with the investment advisors where sometimes they'll say, can you get the oil and gas analysts on? I'd like to hear more of an outlook for natural gas. So I can get the questions from the IA, and instead of just responding to that investment advisor, I can turn around and have this broadcast to our 2,000 investment advisor teams. And that's very powerful. The research analysts understand the importance of a retail network. And when we ask them a question, we share it within our group. So that way, when we get that question from another IA team, we've got the answers. So it's a great relationship that allows us to piggyback on all their work. And more importantly, they make themselves available for Dominion Securities. And that works really well. And I started in 2004. And I've seen that relationship just keep getting stronger as they understand the importance of our Dominion Securities clients to how RBC works as a firm. So it's a great relationship.
Yeah, no, I do appreciate it. And, while it is 8:45 for you when you do the call, for us out in the PEG, it's 7:45. So it is not an early call for me. I'm normally in the office a little bit earlier than that, but I do appreciate it, and it gets us ready for the trading day. Now, I remember when you came on the desk, I'd already been at DS for a couple of years and been in the business for, close to 10 years at that point. I've seen a lot of changes. What changes do you think you've seen in this investment landscape over time that's, helped investors, maybe hindered investors? What do you think about where we are in 2025 versus the investment landscape and how money was managed in 2004?
Oh, that's a great question. So when I started in 2004, I was only covering income trusts. I took the job and my goal was to be a CFO. And it's not the best career advice, but I told my boss, I'm going to do this job for 2 years and I'm quitting. I want to be a CFO. But more importantly, I wanted the job to tell our clients that the income trust model is not necessarily sustainable. At that time, payout ratios were high. There's no way of repaying debt. And I had a list of companies I felt were going to cut their distributions. So I was focused on one area. Now, I enjoyed the job way more than I thought. I enjoyed working with investment advisor teams, the clients, and obviously staying on past 20 years because I didn't realize how great this role was. Now, what changed? Things got volatile in 07, 08, 09. But after 2009, it was a very calm market. You had little volatility all the way to the pandemic. Essentially, the markets were a bit boring. You invested, you made money, and that's how you want investments to be. Now, come 2020 till now, it's been very volatile. I was speaking with clients last night, and one client says, I feel like we're in a recession, and we've been for many years. I have to remind the client the TSX is up over 80% since December of 2019. S&P is up over 100%. People are paying more attention to news and seeing that and worrying about the markets. Now, there's definitely a few things we're watching out for. There is more news. There's more geopolitical risk that's going on right now. And at the same time, wondering when central banks keep cutting rates. Unemployment rates go up in Canada. And the Bank of Canada has been cutting rates to help businesses lower their borrowing costs. And once it lowers, they invest. When they invest, it creates jobs. So there's some uncertainty, but I think clients are paying more attention to that now than they have in the past. Now, we talk about the wall of worry at the same time, because I can give people a reason to never buy into the market, because there's always negative news out there. And if you wait for the perfect time to invest, you usually missed out on a lot of gains. So we tell people, yes, pay attention to it. Let us worry about the bad days. And usually if you stay in the market, even if there'll be some bad days, usually 85% of the time the market goes up, because usually 85% of the time the economy is not in a recession and is growing. And when it's growing, you have earnings per share growth. You have earnings per share growth, the market usually tends to go up.
That is, you actually answered two questions there, because our next question was, clients are rightfully worried about tariffs and the geopolitical situation right now. And, what words do you have for them? And I'm kind of in your camp, like I've learned over 30 years, you just can't time this market. Like look at April, one moment the market's down 2% in the morning and then finishes up 8% on the day. It's you just don't know when you're going to have those days, and you can't miss those days. Rob, do you have any questions for Dom?
Yeah, I was going to ask about, geopolitical tensions and some of the uncertainty we see on trade policies down south. So you can touch on that if you'd like, but kind of one thing off the cuff, we hear a lot about AI development, and maybe without getting too specific, where do you see AI going? What should clients be looking for? What industries do you see impacted most? Any general comments there?
That's a great question, and I'll touch the AI first. So the AI is two things: opportunity and scares people. If you watch Terminator 2, Skynet took over, and that's why you needed the Terminator. And I tell people, watch Terminator 2, and that's the scary event. Now, on artificial intelligence, and the other thing, just a step back, if you look at a decade when the workforce is shrinking, usually technology does better. And if we're running a company, and whether it's in the Americas, so Canada, US, or Europe, you have to recognize that the population is aging. And when the population is aging, the workforce has a risk of going down. So now I need a way to replace workers, and that causes innovation. So if you've seen it in the past, we had Industrial Revolution, you had more robotics. So now if we're running a company and we're having a hard time finding workers, I need to start automating some tasks and essentially reduce costs. And every time I reduce costs, I can then reduce my selling price and or make more money, or both. So it's called efficiencies, and artificial intelligence will help a lot of companies do a lot of efficiencies. Now, how far it goes is a great question. We've worked with it at RBC. We have a platform to work with it. It makes, for example, on our side of investment, it makes research much faster. As far as programming, it makes programming faster. So what we used to do in Excel that could take days, you can now do it much quicker. There is thing though, you need to keep learning. A good example, I did my CA, now called CPA, and in the month of July, I'm doing 21 hours on artificial intelligence and how that has changed accounting and audit practices. I definitely expect companies' margins to get better because of it. And after, actually, it's a good example for you to get me back on your call in 6 months. I'll tell you what the CA order says about artificial intelligence. what has changed in the accounting landscape. Now, on geopolitical risk, every time there's a war or a conflict, people back into the US dollar. They use that as a safety net. When there's conflict, and this time was different, we saw between Iran and Israel, normally oil would have spiked. It went up and then came back down. Iran said they'll block the strait, and I won't pronounce the last name because I'll mispronounce it. They're going to block the strait that accounts for 20% of the oil leaving the area. That's roughly 20 million barrels. That threat alone should have made oil spike. Oil went up. By the end of the day, it was back down. So that tells me that the investors are not overly worried about it, that we'll have a resolution to that conflict and it'll come to an end quick. But it's definitely something we're watching, because if the strait gets closed, and if memory serves me well, last time was 1972, 1973. And if you go back to that time, normally, by the way, when there's a conflict or war, markets go down 6% on average. 12 months later, you're back up. That didn't happen in 72 and 73. The markets 12 months later were still down, because that would cause oil prices to go up. That would cause inflation. And more importantly, the US produces roughly 12 to 14 million barrels of oil a day. They need to buy 6 million barrels of oil per day. Canada sells them just under 4 million. So that means if oil goes to 100, 140, that's a tax on the US consumer, which means inflation goes up, spending goes down. And what you have then is everyone's got to bring back their economic growth. So that is a risk that we're watching. We haven't seen that risk happen yet. And the reason why Mr. Trump is trying to get in there and negotiate and said, let's have a peace process right now. So hopefully that happens. And hopefully, obviously, for human life, there's a resolution to it quick. Defense stocks, interestingly enough, after that attack in Europe, were actually down. American defense stock were up. So I thought that was interesting. And defense stocks, as NATO countries said they're committing to their 2% spending on GDP, it should be positive for spending for defense stock. But eventually, once they do that spending, stockpile, replenish weapons, that will slow down. So I'm not telling you to go in that sector, but definitely that'll have a bit more activity in the near term.
So are there any parts of the market that you're a little bit more comfortable with right now, and any parts of the market you're kind of staying away from? Like, when I look at energy, outside of the geopolitical risk, you have President Trump talking about drill, baby, drill. You have Saudi Arabia raising quotas to tamp down some of the cheating going on within the OPEC nations. You know, what do you see out there?
Great question. So I'll address oil first. So the more the US drills, the lower the price of oil goes, and the less capital goes to US oil. Now, US has US shale. Their break-even price is in the $60 to $65 range. And this is a rough estimate. So if Trump's idea of letting people drill so we find more oil, there's less capital that's going to invest if oil goes to under 60. So essentially, it's self-defeating purpose. Now, for Canada, we export about 4.5 million barrels of oil a day. We have a heavy oil. We mostly sell to the US at a discount because we only have one pipeline not going to the US. So our oil companies, compared to pre-pandemic, have better balance sheets. They're paying better dividends. I'll say they're increasing, but it'll depend where oil prices goes, and they're buying back shares. I like them, but like them a little bit less than 2 years ago. But I'm keeping them in our dividend portfolio. What I'm interested in is natural gas. We're starting to export liquefied natural gas. Roughly, we produce 18 billion cubic feet. We're going to export roughly 2 billion cubic feet. So not enough to make prices go up materially in Alberta, but hopefully we have more projects down the line. And there's one thing people think, well, natural gas isn't clean. It'd be great to have renewable energy, which I agree. At the end of the day, though, when I come home from work, I don't want to hope that it's sunny outside or that it was windy and I have electricity. So you need a base load. And that base load is either going to be nuclear, coal, which is not clean, or natural gas. You can have hydro if you're like Quebec and you have enough waterways, and you can have a steady, reliable base. But unfortunately, not everybody has as much water and has done a good job damming those waterways like Quebec did. So you need some natural gas. So that's an opportunity that could be there. We're watching it. I think it could be an interesting opportunity that we're looking at. Now, on the dividend portfolios, if I look at what companies or sectors can give me 10% dividend growth, and I'm trying to find dividend growers, the grocers right now give me that. So the grocers are interesting. I'd say part of that is also, and I'm not telling you to buy Couche-Tard or Dollarama, definitely speak to Greg and his team. They're also giving you the 10% plus dividend growth there. The other sector in the financials are the life insurance companies. So if there's a slowdown in the economy and loan loss provisions go up for the banks, the life insurance company are not as impacted by that. They don't have loans. They have investments, but they don't have loans to companies and individuals. So that part of the market is interesting. And the other part, when I looked at, I did a screen last year and I said, who or what sector can pay me about a 4% yield and have at least a 5 or 6% dividend growth? In the past, I could find 2 or 3 sectors. Coming into this year, essentially you have the life insurance companies. The banks have good dividends, but you're not getting as strong as dividend growth. So we're interested in the banks, the life insurance companies and the grocers. On our growth portfolio, engineering and construction companies are interesting. Valuations have taken up. People are looking that the governments are going to, Canada, US, are going to look at infrastructure projects. And that's how you get people back to work, especially in Canada, an employment rate of about 7%. And as they announce projects, and Mr. Carney made it clear in his budget that there will be part that's spending and part that's investment. Don't know what those projects are, but definitely there's a lot of projects. The backlogs have been growing. And so some of those names we've put into our growth portfolios on the Canadian side.
Yeah, no, we've been looking at the life insurance companies quite a bit recently. Some of the names you mentioned we own already for our clients. Loblaws has definitely been a huge winner over the last 2-3 years as they finally got all their supply management issues behind them. So that's been quite positive. Okay, so and just so you know, in Manitoba we have ample hydro here. Ample hydro. So we are part of that side of life. So that's good for us. Okay, so we always like to throw a little bit of curveball at our guests just at the end, from all the stuff you said and all the stuff you've looked at. When it comes to investing, when it comes to, making sure people get to their goals, what's the one thing you tell them? What's the one piece of common sense information, because we are common sense managers, that you tend to pass on to people?
That's a great question. And there's so many ways I can think about this. I look at it as what makes me sleep at night. For example, what works well for me may not work well for others. And as you know on the call, I often refer to, don't put this in your mother's portfolio. So give example, unfortunately, my dad passed away, but my dad never cared about the money. He's like, I sent you to school, it's your job. I take care of watching hockey, you take care of my money. So I always dealt with my mom for the portfolio. My parents don't like risk. They went through some risk. They know they have enough money to maintain their lifestyle. So for example, for them, and I'm not saying this is a great policy, but it works well for them. 5 years GIC, all in a registered account, the money's there. My mom goes, I don't want to take more risk. I'm like, listen, you're set up for 5 years. This will take you to 85. The rest we're leaving in equities. And it's funny, her comment goes, okay, if you're right, you'll inherit more. If you're wrong, you'll inherit less. Which actually convinced me that's what we're doing, we're leaving it in equities. So the asset allocation is important. You've got to be able to be comfortable with it and have a plan and stick to the plan. Investment should be like hitting singles and doubles. You don't want to be investing and say, I need to hit this grand slam on the first pitch, or I'm moving out of my house. Investment should be boring, and that's how you keep compounding your money, and it keeps going up. Good example, like our dividend portfolio, And sometimes in the markets, I wouldn't even turn on where the market is, because I bought companies to have a good yield. They keep increasing the dividends, and that's what I want to own. And the returns over 10 years are just under 10%. So essentially, if you look at that, you're doubling your money in about 7.5 years. To me, that's what's comfortable. Now, to others, says, no, I want to double and triple every year. It's going to be hard, and you'll have some losses. So I'd say be comfortable so you can sleep at night, and importantly, have a plan. I know we have My GPS, which is a planning tool. And when you sit down and do it, then you don't have to worry that you need a double or triple per year. You look and says, by the time I retire, I will have achieved my goals. And now you can sleep at night and not have to spend every day worrying about where the market is. And also when the market goes down, by the way, that's where you want to have some cash on the side to go back and buy into the markets. Essentially, if great companies come on sale, that's when you want to be buying them.
Yeah, no, there's no doubt. Like, if you're not uncomfortable buying a company, then you're not buying it at a great price, right? And I will tell viewers of this right now, I did not coach Dom on those last words. It does sound exactly like what we've been telling clients for the last 20 years. So Dom, thank you for reiterating that. And thank you for your time today. We do appreciate getting you on our video, on our new YouTube channel. So for people that haven't checked out our YouTube channel, please check it out and follow us on YouTube now. We're one of the first advisory teams to have that in Canada for RBC Dominion Securities. I will mention one thing. Dom is a big Montreal Canadiens fan, despite the fact he's living in Toronto and has to hear about Mitch Marner every day. But I'm sure he's hoping that he gets Nick Ehlers, but you know, I'm sure Nick's going to want to stay in Winnipeg. So you're just going to have to stay with Liney right now, and we're hopefully going to stick with Nick. Okay?
Thanks.
Dom, thanks for your time today. Appreciate it. Enjoy the heat wave in Toronto. It kind of, if you're watching this, a little bit of glitchy video sometimes maybe, but because of the storms that are going on out there, but great content, great words, Dom. Thank you very much.
Thank you.
Thanks,
My
Tom.
pleasure. Speak to you later.